How many of you have read Harry Potter? Raise your hands if you've read the Harry Potter books. Some of you, not all of you. This next gentleman wrote a book that did better than Harry Potter in Japan. Was #1 for 6 weeks. It's called The Princes of Yen. I'm really excited about our next speaker because in addition to many different things, he is at LSE, Oxford, Education Japan, a global education, global impact, because he's a highly rated chief economist, a senior MD, a senior consultant, a visiting scholar and researcher. I could go on and on. The World Economic Forum summarizes him as a global leader for tomorrow. He's got his own monetary policy that he's introduced to the world called QE, quantitative easing. All of that in one human being. And that one human being is about to join us on stage. Please welcome up Richard.
Thank you. Thank you very much. It's a great pleasure to be here. Thanks for the invitation. I would like to talk about a topic that I, in the past, didn't used to talk about. I used to talk about central banking. Today, I'd like to talk about decentral banking. Now, we're all presently concerned with some of the things that are happening in the economy. Inflation. Is it going to get worse? Are we where we were a century ago in Germany when modest inflation started to rev up and the numbers became bigger and bigger? Well, obviously you should talk to those who forecast the present inflation, not those who were surprised by it. And I warned in April, May, and throughout 2020 there will be significant inflation coming up 12 to 18 months later, and this is what we are currently, of course, experiencing. How was that forecast possible? I will show you. I will give you the tools that you need. And I think it's important to also go back to an earlier experience, half a century ago, when we had significant inflation and when we were told an official story about why there was inflation in the 1970s, and we have to critically examine that. It was a decade of stagnation and inflation, stagflation. The US consumer price inflation peaked at 13.5% at the end of the decade. Of course, as you know, the first bout was in 1974 with 11%. Germany did a bit better, but these are all the peak inflation rates in that decade. Other countries, Japan, the UK, had fairly high double-digit inflation, 23, 24%. Why this inflation? What is going on with the monetary system? The official narrative, I'm sure many of you will know, is, well, these are external events, nothing to do with the central planners. A war broke out, OPEC therefore imposed sanctions against the US and Europe, creating an energy supply shock, causing an oil price shock. Now, all this happened in October 1973. So then we see the oil price jumping from $3 per barrel and that was in September 73 to $12 per barrel in the following January 74. That's the story. And of course, today the story is very similar: war, sanctions, energy supply shock, energy price shock. Let's look at the evidence. But to answer that question, we need some tools of analysis. And while we're at it, and while I'll show you these tools, we might as well solve some of the other big puzzles in the official narrative that they haven't really explained to us. Why do we get these asset price bubbles followed by banking crises? There's been 100 in the past half century. Why haven't the regulators learned how to avoid these? Why have those developing countries that adopt the recommended policies by the IMF and the World Bank, why haven't they been successful? I mean, how many, since the World Bank and IMF were created, at the end of the Second World War. How many have moved from developing country status to developed country status? Oh, none? Well, 5 countries did, but they didn't follow the IMF, World Bank, Washington Consensus advice. Well, how did they do it? China, Japan, Taiwan, Korea, Singapore, how did they do it? What policies did they adopt? And of course, the question we started out with, why the present inflation? And why didn't the QE, central bank stimulus in 2008, not cause any inflation? Of course, that's what took a lot of people by surprise this time round in 2020. It's going to be like 2008, no inflation. Of course, the same people in 2008 said inflation is going to happen. So they got it wrong time and again because they used the wrong tools. What are the right tools to analyze this? And as we explain this, we can also explain why Japan, so successful for many decades, on track to overtake the US by 1993 in GDP, actually then did not overtake just before, in 1992, moved into a 20-year recession. What happened there? There's another question we can solve with the same tools. In the UK, they are constantly concerned about low productivity. Why is productivity so low in the UK compared to Germany? Much higher productivity there. What's happening? All right, so you need those tools. These are the secrets of the banking trade and the rules of the money game. If you ask ordinary people out there what matters in the economy, I bet you they'll say money, banks. And of course, that makes some sense. If you ask the expert economists, they will talk about anything else but money and banks. They don't matter, they're left out of models, and they will say, well, the interest rate is what matters. Consider interest rates. But when it comes to banking, some of you who haven't studied this as a topic may be surprised that for a whole century there have been 3 theories of banking, and the experts couldn't agree which one it was that was actually explaining what banks were doing. Since the 1960s, the dominant theory is the financial intermediation theory. Banks are just financial intermediaries. They're just like non-banks. There's nothing special about them. The older one from the 1930s to 60s is the fractional reserve theory, which says that each bank is a financial intermediary, is not special, but somehow in the system there's something going on, like money multiplication. And then there's a third theory, the credit creation theory. That's the oldest. And that says, no, banks are not financial intermediaries. Each bank individually creates new money. And where the 3 theories are different is concerning that question. When a bank gives a loan, where does the money come from? Now, of course, it's pretty unscientific to have different theories and just keep arguing. What's the scientific thing to do? Do some empirical research, do an empirical test. So I conducted that. Published 2014, 2016. You can look them up. One is the most downloaded Elsevier publication of all disciplines. Can banks individually create money out of nothing? And the conclusion is, of course, that the official story, banks are intermediaries, they gather the savings, do the analysis, and then give out the money for investment, is wrong. And actually, the fractional reserve theory, even that one, is also wrong, because that's not how it works. Each bank is not a financial intermediary. It is the oldest of the 3 that is accurate. Each bank creates new money when it gives out a loan. That's how 97% of the money supply is created. That's where the money supply comes from. And of course, from the legal side, it's much easier to come to that conclusion. While the economists say banks are deposit-taking firms that lend money, the legal fact is, and particularly if you look at English law, where modern banking was established in the 17th century, and it's very clear at law, banks don't take deposits, and banks don't lend money. They don't take deposits because there is no such thing at law as a bank deposit in English law. It's a loan to the bank. And they don't lend money. They purchase securities, namely the loan contract you've signed is an IOU, a promissory note, a debt instrument that the borrower issues and the bank is purchasing it. And then the bank owes you money. But you see, if the bank owes you money, we call that a deposit. And so the loan contract goes on the asset side of the bank balance sheet, and then the borrower's account at the bank is credited with the number that the bank owes the borrower, which is created out of nothing. And in the empirical test, I confirmed this new money accredited to the borrower's account is not transferred from anywhere inside or outside the bank, and that's what what it is, new money creation, ex nihilo. So banks are special, they create the money supply. This is credit creation. Of course, it's key what is the money used for what purpose, and its economic impact will depend on that. And that makes banks very powerful because that's a decision that will reshape the economic landscape within a very short time period. Of course, central banks have a lot of influence over the banks, and they can therefore steer that process. Now, there's three scenarios because well, initially, you can divide this money creation credit, it's a credit creation process, into two streams: the money that goes into the real economy, GDP transactions, and the money that is not even used for GDP transactions. That's when bank credit is used for asset purchases. And that gives us these three scenarios. When banks lend for asset purchases, this money will drive up asset prices and create asset price bubbles. And of course, that's a Ponzi scheme. It's never sustainable, particularly when it's sufficiently large enough. It will lead to a banking crisis because, you've pushed up asset prices 100, 200%. If you then stop creating more credit for asset purchases, because it will only continue while you keep doing the same thing. If you stop that, asset prices will come down, the late-coming borrowers will go bust, non-performing loans go up, and of course, non-performing assets have to be financed through equity, and bank equity is famously very small, and that creates your banking crisis very quickly. Having pushed up asset prices, say 200%, they just need to drop by 10, 15%, and the banking system is bust. But that's one of the scenarios. The other unsustainable form of credit creation is consumer credit. That's when you get consumer price inflation, when banks create money for the purchase of things without ensuring that there's a creation of new goods and services. And that leads us to the last box, case 3, the redeeming feature of the banking system. We don't need to have inflation. We don't need to have asset bubbles and banking crises. If you just ensure that bank credit creation is used for productive purposes in the creation of goods and services, implementation of new technologies, increasing productivity, you will always get higher growth without inflation. That's, of course, how the East Asian economies managed to have double-digit economic growth for decades, by steering bank credit into the green box and suppressing the unproductive and unsustainable credit creation. So once you understand this, bank credit creation, how it works, and the three scenarios, and you can do more sophisticated analysis with that in further breakdowns, but it gives you the tools. You understand that this is a game changer. We don't need to have these cycles, unemployment, underdevelopment, and the recurring banking crises. And there's a lot of empirical work to back this up. These various three scenarios, the asset bubble scenario when the credit for financial circulation is boosted. The graph here is Japanese data as a share of total credit doubling from 15 to 30% during the course of the 1980s. Of course, the biggest asset bubble was created here. You see the overhang of excess credit creation way in excess of GDP because it wasn't going into GDP, it was fueling the asset purchases. And then when you restrict credit, that's what's going to crash the whole thing and also bring down the banking system. And all that is irrespective of interest rates because they follow, as empirical studies have shown. They're not the causal tool, we're told. So these are the tools. Now let's reconsider the 1970s inflation. Was that really due to an external energy price shock? Well, let's look at the credit creation data, shall we? This is the US data here. And we find that central banks, and the interesting thing is totally synchronized among the leading central banks. They switched on the money creation, printing presses from late 1970. By mid-71, we had very high credit creation, and they peaked in early 73. And then there was a second bout of massive credit expansion in the late 70s, and that created these two bouts of inflation. And you don't need other explanatory variables for that. Look at Germany, massive credit expansion, peaking in March 73, then coming down, then the second bout, the same in Japan, peaking in December 72 at 25% credit expansion. And these are policy variables because central banks are in charge of monitoring this, and they have many tools to fine-tune this, which we could discuss if we had more time. So back to 2020, which is where my inflation forecast comes from when I got this data from April, May 2020 onwards. And of course, also the comparison to 2008. And what you see here is essentially two lines. The gray line is bank credit creation in the US, and the blue line is the Federal Reserve activity and credit net liquidity creation. There's a huge blip there in 2008, which we all know about. And so initially, many economists were saying this will cause inflation. But no, it couldn't, because the Fed is just a fraction of the banking system, which is much larger. But this large wheel of the banking credit creation, that was turning negative. You see the gray line turning into negative territory. And therefore, total credit creation didn't actually rise very much. And of course, the Fed also, under Bernanke, adopted my advice of the true QE as it defined it in '95 in Japan, to bail out the banking system at no cost to the taxpayer, because it doesn't make sense to make the taxpayer pay for what the regulators are responsible for, by purchasing the non-performing assets and moving them onto the Fed balance sheet or subsidiaries' balance sheets. And he did that. That's why the US banking system recovered very, very quickly, and the economy was back to normal, whereas in Europe they weren't allowed to do that, and so we had longer recessions. Now compare this to 2020. In 2020 March, bank credit creation had been revved up to enormous growth rates, previously only seen just before the 2008 crisis, and the central bank revved up its own liquidity injections. And while the Fed has since, by 21, reduced its credit creation, which is why in our currency model, of course, the dollar had to strengthen, bank credit creation is way up there again and continues. And the picture is similar in many other countries. And so by this comparison, we see the difference. Bank credit creation is the bigger wheel. That was actually another policy decision by the central banks. The central banks did an operation that's not very well known. They forced the banks to increase bank credit in the real economy by purchasing assets from the non-bank sector, which boosts and creates out of nothing new bank deposits, which were then used largely for consumption, where also, of course, government policy helped and accelerated this. So the inflation in the 70s and our inflation since late 2021 is due to conscious policies taken by central planners at the central banks. What about the asset bubbles and recurring banking crises? Well, we can't go through the 100 cases we had in the last 50 years, but trust me, the conclusion of the analysis is this is credit creation for asset purchases driving this, which is under control of the central planners that are in charge of monitoring the banking system. And why have the regulated central planners not learned how to avoid this? Well, of course they know. These are policy decisions. Let's try to answer some of the other questions. What is going on, and what are these central planners doing? Well, there's two theories here I'd like to deploy now. Revealed preference. Samuelson proposed that. Says that you shouldn't trust what they say, watch what they actually do. That reveals their true preferences. And it's very clear with these central planners, they love boom-bust cycles. And the theory of bureaucracy says that bureaucracies want to expand their influence and their power. And over the past 50 years, particularly with the 70s inflation, that was deployed by the central planners to push for greater independence. And as they become more powerful, the amplitude and frequency of cycles has increased. Why? Well, the more boom and bust cycles we have and the bigger the crashes, the more power we give each time to the central planners. I called this in 2003 central bank risk, and I warned that we'll get more and more boom-bust cycles, and I warned of a very big global financial crisis, which then happened in 2008, and I warned that they will give the central banks even more powers, and this will not solve anything. It will just ensure we'll have another round of crises. This is regulatory moral hazard when you reward those central planners for creating these problems. But why don't more people know about this? Well, because people are trained in this false economics, I call it fiction economics, which claims that there's equilibrium, and in equilibrium prices are key, and the key price overall is the price of money, the interest rate, and that's what you need to watch. But it's really like this magician on stage, distracting your attention while the trick is taking place elsewhere where you're not looking. And of course, what is moving the economy is credit creation, as I showed you, and interest rates. They don't work as they tell you. The official story is lower rates lead to higher growth, higher rates lead to lower growth. We've been told this for 200 years. All different schools of thought, from classical economics, David Ricardo, to Keynes, to Friedman. They all say the same thing. What's the empirical evidence? There isn't any. There is no empirical evidence that if you lower rates, you get higher growth, and if you raise rates, you get lower growth. Again, I conducted the first empirical studies on this, published, just shown, and the result is interest rates and economic growth are positively correlated, and the statistical causation runs from growth to interest rates, not the other way around. And you can check it for yourselves. So the official story, high rates lead to low growth, low rates lead to high growth, is opposed by the reality that high growth leads to high rates, low growth leads to low rates. And of course, bond markets have crashed again, last week, because, well, if you create high inflation, of course, this crashes the bond market. I mean, what's new? If you boost nominal GDP, and largely due to inflation, bond yields have to go up, bond prices have to go down. This is the result of these conscious policy decisions by the central planners. So as a rule of thumb, I mean, the truth is the opposite of what they tell you in economics, which was one of the early disciplines that was systematically controlled top-down to propagate convenient untruths while covering up the truth and suppressing dissent. We know this now since various events in 2020 in other disciplines. So let's now look at a positive story. The productivity puzzle. A gauge of a thriving economy is when it can export, because if you can be a leading exporter, that means you're very competitive. You can sell in the world in this very competitive market. Now here we've got various exporting countries. The name of the country is very small, so you don't see that the one that's exporting most in this is until 2009, is Germany, followed by China. So Germany had, for 200 years, consistently a great success story in exports, beating even Chinese exports for many years, per capita way ahead of China. And in fact, the interesting thing is that many of these successful exporters are small firms, family-owned businesses, tiny firms. And we call them hidden champions because they're SMEs, small and medium-sized enterprises, but they have global top market share, 1, 2, 3 market share, like a champion in the Olympics. So we call them hidden champions because they're small firms, you don't know the names, they're not brand names. So look at the world. Who's got the largest number of hidden champions, SMEs with top market share? Germany stands out head and shoulders above other countries. Of course, Austria is not doing badly. Switzerland is not doing badly, given that this is absolute numbers. But how is it possible that these countries, particularly in the German language countries, are doing so well? What's the explanatory variable? Well, in banking, there's a principle, and we did a big study on the largest banking markets, the US, with over 10,000 banks over a long time period, several decades. Conclusion is, large banks want to do large deals with large customers. Who lends to small firms? Small banks, but small firms are the biggest employer, 2/3 of employment in all economies. Therefore, what we need is small banks. And that's really what the central planners don't like, and they've been killing small banks, left, right, and center. Germany has the largest number of banks in the EU, and there's war against these banks. It's official ECB policy to kill them, and the ECB has been very successful. Do you know how many banks have already been killed in the Eurozone since the arrival of the ECB with its anti-bank policy? 5,000 banks and counting. And Germany has these small local community banks. 80% of all banks are these small local banks. And that's how the economy has been successful in the exports, and the small firms, the hidden champions, have been successful. Now, the same is true for Japan, Korea, Taiwan. Now, China is an interesting case because it started out like the Soviet Union. And it had only one bank and then switched. In fact, a centralized system is also the UK system. We only have 5 big banks, very concentrated, and that economy has therefore low productivity because these banks are so big, they only want to lend to large firms. There's a report which concluded the problem in the UK is the banking is dominated by the big 5. Small firms can't get funding. Now that report was issued more than a century ago, the Colwyn report. Of course, nothing was done about this because the City of London is very influential in the UK, and the big banks like it that way, and apparently the regulators like it that way. So low productivity. Most lending is for unproductive financial asset purchases. China, started out with a very concentrated banking system, Soviet-style economy under Mao, one bank essentially for the whole country, but then decided under Deng Xiaoping, this is not really a great system. He went to Japan, he looked at Germany and concluded we need banks. And he went out and created thousands of banks, small banks, local banks, credit unions, savings banks, provincial banks. And so China now has almost 5,000 banks, and of course the rest is history. Create more banks, you get more economic growth. If you ensure that these banks lend mainly for productive purposes. So centralizing is not a good idea. Decentralizing has been successful and explains the case of these only 5 countries that have moved decisively from developing country status to developed country status since the IMF and World Bank were introduced, and they ignored all these IMF World Bank policies. They followed credit creation-based policies, and that's how they achieved their high growth. So what we need to do is, oh, by the way, yes, Japan is an interesting case because, so the other puzzle was why then the crash in Japan and 20 years recession? Well, you can read up in my book, Princes of the Yen, kindly mentioned by the moderator. The central bank forced the banks in the 80s to massively expand bank credit for asset purchases. And the goal was to kill those banks, to amalgamate them and reduce the number of banks drastically. I was at Deutsche Bank as an intern in 1989, and their chief economist just had lunch with a Bank of Japan guy, came back and said, Richard, do you know what I just heard over lunch? 1989, the top 20 banks in the world were Japanese banks. These 20 city banks, they call them very large banks. The Bank of Japan wants to reduce the number of city banks from 20 to 3. Because that's what they have achieved with their policy that you can read up on. So that's what the central planners want, and I need to wrap up now. What do we want? Well, we have to be careful what we ask for. The central planners don't like the banks. They want to kill them. And one of the tools they want to introduce now to kill the banks is central bank digital currencies. Because this is the central bank, the regulator, stepping into the arena and saying, we're going to compete against the banks. We're going to offer current accounts. And if you do it that way, this is direct retail CBDC, you will kill the banks. And that's of course, the goal of CBDCs, because bureaucracies want to expand their power and influence. And we've seen what the central banks have been doing, these central planners. And of course, on top of that, they have already been killing banks through their low and negative interest rate policies, and a whole number of other policies. Now, perhaps that's good if we don't have so many banks. Well, it will reduce economic growth to zero as well. Or perhaps that's a good thing. Well, certainly the media has been telling us for the last few years, oh, growth is bad, it's the enemy of the environment. That's absolutely not true. Growth can't harm the environment because economic growth doesn't exist. It's a statistical illusion. The environment is harmed by destructive, harmful actions. They can happen at zero growth. Therefore, growth is not the enemy. In fact, when you have sustainable growth, high and sustainable growth, that's when you can really protect the environment. But that's another topic, and we need to wrap up this. So they're wanting to sell this CBDC by combining with other policies such as universal basic income. They will say that, we need to support all these people that are unemployed when we forcibly shut down businesses and introduce other Soviet-style policies, as we've seen since 2020. Therefore, to do this efficiently, we'll need CBDCs. But CBDCs are really not currencies, they're control tools. They're not about anonymity, they're about knowing who's using money for what purpose, and not just monitoring, influencing it, controlling it. Oh, you've criticized central banks? Sorry, we'll shut down your purchasing power. Or you want to leave that area and buy outside? Well, sorry, that will be too many carbon credits you're using up, and so you can't use outside this area. There's all sorts of possibilities. Certainly central planners love this idea. Just watch the movie of the video of the BIS managing director, Agustin Carsten, talking about CBDCs, and he'll explain it to you. So, the anti-bank policies that the central planners have been taking, and that includes the PSD2 EU directive to force banks to give customer information to their competitors. The central bankers have really worked very hard to undermine traditional banking, should get us to conclude, we want the opposite. We want decentralization. We should establish new banks, professionally run, very well run, that deliver what people want, good services, not some telephone center where they transfer you and then cut you off and you have to start again and wait, but actually traditional banking that delivers simple but the needful services in the financial sector, and of course credit creation for productive purposes. Therefore, local banks are the answer, and establishing many new banks. The local cooperative principle is an important one that we can also use to counter the centralization movement based on self-determination, self-responsibility, self-administration. And of course, in a small country, I think this is very much what people are thinking, but that's what we can learn from small independent states. And therefore, I'm engaged in setting up banks, and there's various activities I'm doing. A local first community interest company is establishing banks, and we're working with the Valhalla Network that I'm also chairing to get the crypto community to back the same. If you think about it, it's quite obvious. I mean, there's already a whole number of tokens and alt currencies out there. Well, why don't we combine this with a whole community banking network? Because then we can really ensure that what many in this field want, decentralization, decentralized finance, will actually be implemented in the right way that empowers local people. Local banks will be accountable to local communities.
I'm so sorry. This is the part of the job
we could join.
I hate the most because
well, that was my last sentence.
So much good content, so much good value, but luckily we also have you for the panel.
Excellent.
So you're going to stick around for a bit. Do you have a slide? Oh, there we go. So there's the contact details. I believe we've got lots of good content and slides, so maybe you can get in touch directly with Richard. Richard, go get some water. Can we give the man a hand? He's been talking for a long time. Good content. Go get some water and then come right back, okay?
Thanks very much.
All right, thank you.